Hello everyone. NIO recent earnings call reveals strong vehicle margins, revenue growth, and strategic expansion, driving bullish investor confidence. NIO recently held its earnings call, and I've got some truly exciting bullish news to share. Following the call, the stock price has surged, reflecting the positive results. Let's dive into the key highlights that triggered this upward movement. First off, this was a robust quarter for NIO, and what really caught the market attention was the vehicle margins. They reached an impressive 12.2%, a considerable improvement from 6.2% in Q2 of 2023 and 9.2% in Q1 of 2024. The increase in margins is a direct result of supply chain optimization. NIO CEO had previously mentioned that the company would work closely with suppliers to reduce costs, and it's clear they've successfully delivered on that promise. This optimization has been crucial in improving the vehicle margins, allowing for better financial performance. NIO total revenue also stood out, coming in at $2.4 billion. While there is still a net loss of about $700 million, this can largely be attributed to increased selling, general, and administrative SG&A expenses, as well as research and development R&D costs. The R&D investments remain steady, but SG&A expenses have risen due to the ONVO launch, increased marketing efforts, and the need to reward sales teams as vehicle sales climb. These factors have contributed to the overall net loss, but it's not unexpected given the current expansion phase. Now, moving on to the big news regarding ONVO. NIO expects to ramp up ONVO deliveries to 10,000 vehicles per month by December, with the target rising to around 20,000 vehicles per month in 2024. The initial delivery phase is progressing steadily, but the company is confident in its ability to scale up production. By the fourth quarter of this year, NIO aims to achieve a 15% vehicle margin, which is an ambitious but achievable goal considering the current trajectory. Supply chain improvements and strategic product optimizations have been central to these margin improvements, and further gains are expected. Looking further ahead, NIO's long-term objective is to deliver between 30,000 and 40,000 vehicles per month, and they're targeting a 25% margin, which would be a significant step towards sustained profitability. The ONVO brand is positioned in a highly competitive segment of the market, one that includes over 8 million vehicles. Despite the intense competition from plug-in hybrid electric vehicles (PHEVs), extended-range electric vehicles (EREVs), and other electric cars, ONVO is well placed to capture a healthy share of this market. Achieving a 15% margin for ONVO is not only reasonable but also a strong indicator of the brand potential profitability. SG&A expenses have been on the rise, driven by increased marketing efforts for ONVO and bonuses tied to higher sales volumes. It's expected that ONVO deliveries will reach 20,000 vehicles in Q4, and the cost of ramping up production and marketing is being carefully managed. While R&D spending will remain consistent at around 3 billion RMB each quarter, fluctuations may occur, especially as new products like the ONVO L60 enter the market. The L60, designed with efficiency in mind, is also expected to achieve a 15% margin once production scales up. NIO production capacity is another point of focus. The company is on track to have 3 factories fully operational by Q3, which will significantly boost output. While there are short-term production challenges, these are expected to be temporary. By 2025 and 2026, NIO will have the capacity to produce far more vehicles, paving the way for continued growth. Capital expenditures (CAPEX) in 2024 are projected to be lower than in 2023, as the company has postponed certain projects and is spending prudently. CAPEX for 2025 is expected to be similar to 2024, even though 2024 will be lower compared to the previous year. As NIO sales volumes increase from 30,000 to 57,000 units, so will SG&A expenses, driven by higher sales-related costs and additional marketing initiatives. The ONVO brand's store strategy has also evolved. ONVO stores have a much lower average rental cost compared to NIO stores, which is part of the company effort to increase efficiency while maintaining a high level of customer service. These cost savings are significant, especially as the company continues to expand its footprint across multiple market segments. Another notable point from the earnings call was NIO plans to introduce the Firefly model next year. This new addition will further diversify the company product range, offering vehicles priced between 140K and 800K RMB, while the battery as a service BOS option will broaden the price range to 100K, 700K RMB. This multi-brand strategy is a crucial part of NIO growth plan, enabling the company to cater to a wider array of customers and meet varying needs in the market. Geographic expansion is also on the horizon. NIO plans to push further into third and fourth tier cities, where its sales have historically been lower compared to the first and second tier cities. This will be supported by an expansion of NIO swap stations, part of the county swap plan, which is aimed at bolstering the company presence in less saturated areas. This strategy will complement the expansion of its product portfolio and help drive future growth. On the product side, the highly anticipated ET9 remains on track for a successful launch next year. Additionally, NIO is expected to unveil the third-generation ES8 SUV later this year, with deliveries slated for next year. Both the ET9 sedan and ES8 SUV will be built on NIO cutting-edge NT 3.0 platform, which should position them well in the high-end market segment. There was also an important update on NIO international operations. Selling vehicles in the European Union (EU) is becoming more expensive, prompting the company to take a more cautious approach. While NIO isn't exiting the EU market, they are slowing down expansion efforts there. The CEO emphasized patience, stating that growth in the EU will take time and that the focus for now is on other markets where there's more immediate potential. One of these markets is the UAE, thanks in part to the CYVN investment NIO recently secured. As part of the investment agreement, NIO will expand into the UAE market, and both the ONVO and Firefly brands are seen as being more globally competitive, particularly for markets outside of China. These brands require fewer infrastructure investments compared to NIO premium models, making them more suitable for rapid global expansion. China's new energy vehicle NEV penetration rate is already at 50%, and NIO CEO expects it to reach 80% in the next 2 years, driven by the rapid adoption of NEVs in the country. The CEO pointed out that Norway experienced a similar trend, quickly jumping from 50% to 80% penetration. However, the price war in China is putting pressure on many automakers, especially those reliant on internal combustion engine (ICE) vehicles. Japanese and Korean brands like Nissan and Mitsubishi are struggling, with some even pulling out of the Chinese market. The price cuts necessary to compete in the electric vehicle market have been detrimental to their profitability, forcing some dealerships to close down. NIO is also working to narrow its losses in other business areas, with the goal of making them profitable in the near future. A key driver of this improvement will be the changes made to NIO insurance service packages and the introduction of a fee structure for battery swaps. Previously, NIO offered unlimited free battery swaps to early customers, but this has now been reduced to 6 free swaps per month, and newer customers receive only swap vouchers. Once the vouchers are used up, customers must pay for swaps, contributing to the profitability of NIO's swap station network. At present, swap stations require an average of 60 orders per day to break even, and many are already nearing that threshold, with 30 to 40 orders per day. The CFO acknowledged that profitability has been hindered by the early offer of unlimited free swaps, but this is gradually being phased out. NIO has also strategically deployed swap stations in areas where they want to increase sales, even if those areas don't yet have a significant number of NIO owners. This early deployment is aimed at boosting sales in those regions, although it does mean that some stations are currently operating at a loss. Overall, the outlook is extremely positive for NIO. The company is executing its growth strategy effectively, and the stock's performance reflects the market confidence in NIO long-term potential. What do you think about NIO latest earnings report? Let me know your thoughts in the comments below. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.